Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we made it to Friday, and happy Friday the 13th for those that enjoy the dark side of Friday the 13th. But we have our favorite, the Primary Vision Frac Spread Count, and we're also going to look at what are some of the new estimates with crude demand, what are some of the shifts that we're seeing, where we want to touch on NGLs because NGL prices or natural gas liquid prices keep getting better. And then we're going to look at some just recent economic indicators that have come out to follow on what we talked about this past week. And then we're going to look at what is going to come next week as well. And then we're going to round it out with our breakdown of WASD, which is just a very important side of the grains because crops continue to see some price appreciation. So now jumping right into the frac spread count. So we are up by 3. So we went from 235 to 238. And when you look at where some of the shifts are, remember when last week we were talking about how it was more of like a moving day because you have spreads that are going from point A to point B. You have rigs moving. So rigs were plus 10. We had a lot of activity coming back into the market. We had 8 of which were, or I should say 9 of which were coming into the oil side. So when you look at what it continues to happen, we keep seeing this shift of let's bring back more rigs, and then the spread count's going to continue to move up, but just not at the same pace. And not to say that we're going to get 10 rigs every week, but there's going to be that continuous add to see some of this appreciation. So one of the places that we saw the increases was in the Permian. We saw the Permian had an increase, but then the Williston or Bakken had a nice little jump, and that's something where we think you're going to see a fairly steady increase to about 20 spreads or so as we go into not only just the end of August, but more into September. And just to give some color on guidance, one of the things that I had said was that we were going to get to about 250, 255 by the end of September, by the end of August. But when you look at where we are right now, so we continue to see some of the bigger basins pick back up. It's just going to be a matter of when do the smaller basins, because remember, we do the frac spread count, we break it into 17 basins. So some of these smaller ones are at 0, and typically they're at this point, they're at 1 on their way to 2. And we will see that addition. The question is going to be, is it in August or is it going to be in September? And I think it's going to be a mixture of both. So that's why we're still going to see that 250 to 255. It's just, will we get there by the last week of August or the first to second week of September is going to be a matter of when do we see some of those activities. But that's, just based on what we've seen, clients we speak with, that is something that will be attainable as we go into really the fall push, if you will, and we're going to talk about some of that in a minute. So this is just looking at some of those, a chart that we had shown before. It's going to be on AOGR that we have an article coming out in the August edition, and it's going to show that we were pretty spot on in terms of where things were going. But this is just looking at where rigs are in relation to spreads. So you can see rigs have continued to pick up. We've seen that the ratio between the two start to come back down. And it typically, when you look at where it is in previous, it's about 0.45. We got to the high of 0.50, but you can see how it's started to come back down, and that's really because rigs continue to come back. And you're going to see that addition, as we've been saying, that Q3 was going to see that push of additional drilling because we've worked through a lot of this excess DUC count, and now you're going to start to see DUCs or drilled but uncompleted wells start to get added back and kind of bridge that gap. And this is one of the ones where when you look at natural gas liquid pricing, propane at $1.14, you have ethane continuing to be robust. And this is just looking at MONT BELVIEU. So what do we have right now? So when we look at NGLs, propane is used for crop drying. We're coming into the harvest. So you're going to have propane that's going to get a bid from when we look at where things sit. As we talked about in the EIA show, propane is now below the 17 and 18 numbers on storage. We continue to see LPG demand internationally remaining very robust. So again, you have the international market, you have local demand, and you have this pricing, and we're just not seeing the same type of creation or drilling for NGLs, which is why when we look at the three streams, we still believe that there's going to be a bigger focus on the liquid side, just given where the backdrop is and how we continue to see the benefit. And in previous years, a lot of this has been driven by ethane. And now ethane has normalized a bit, but not that it's normalized in the sense it's come all the way back down. But we have a lot of plastics demand, a lot of petchem demand domestically, and now we're exporting more ethane, ethylene, and that is providing some of that support, which is the same thing as the LPG side, where we continue to have record-setting exports, and we're going to set a record for this year, given there is more export capacity for the LPG side, but there's also a ton of demand, especially in Asia. So then when we look at natural gas, and again, I'm a defeated gas ball at different points in time. So that's why when we look at where things are going, you always have to look at this with a grain of salt, because weather can shift everything. And if we have a really warm winter, then everything that we're talking about is always going to have to be reassessed. But just as we sit right now, we have to consider what is happening. And when we look at the 5-year average, so we're sitting right now at about 2.776 TCF. And then when you compare that to where we were on the 5-year average, we're normally right now at about 2.95. So when you look at just what's in storage, and then you can see over the last 10 years, we're right at where we were in 2019. And the reason why I don't want to say it's different this time, because that's a death nail. And for those that have lost money in natural gas, you know what I mean when I say that. But when we look at natural gas, we have a lot of LNG demand. We have a lot of international demand when you look at TTF pricing, when you look at PKJ. When you look at those PKJ being Japanese and Singapore, when we're looking in Asia and we're looking in the US, there's a lot of demand for LNG. And that is helping to drain or maintain this low level, mixed with the fact that we have low associated gas. We don't have guys in the Marcellus ramping up aggressively, as our clients can see with what the spread count is in the Marcellus. The Haynesville's seeing some additional capacity, but again, we're not seeing the supply at the same time as we continue to see heat waves. A lot of demand within the U.S., but also that demand internationally, which is helping to support some of these levels. Again, a warm winter and everything I just said becomes a moot point. But you always want to look at what is against the 5-year average, where are we sitting, and then what is storage going to look like, because we're heading into the shoulder season, so you want to see where are we going to peak. Some individuals will say 3.2 trillion cubic feet. Some will say something closer to 3.5, both of which are going to be obviously 3.2 is more bullish, but, coming into that 3.5, 3.7, you're going to still be right in a fairly strong position as we go to the winter, and in terms of where we're going to shake out as we go through, because obviously heating demand is going to increase. Now, when we turn back to crude, we just look at the China right now. So the teapots just got their new crude quota. We're going to talk about that more on the EIA show. But it was cut, which was expected, nothing crazy there, which is why we talked about trying to utilize more fuel oil and trying to trade in fuel oil more than in crude, just because they're having these restrictions. But even with that, you can see that we are back to a seasonally adjusted high, continuing to stay in this saturated level when we look at crude. And that's also turned to a little bit less crude tankers heading to China. Again, we'll talk about that in the EIA show, with more actually starting to signal the U.S. So we are starting to see additional crude coming into the Gulf of Mexico, into Pad 5. And again, those are things that we're going to talk about in the EIA show. Then when we look at fuel oil stocks, they dropped within China, but it's still below 2014, but you can see just how elevated it is. And this remains the focal point when you're looking at different trading. How do you move this product throughout the system, trying to resell it not only into the international market, but also into the state-owned. Now, after the IEA came out with their adjustments, and remember, not to say that we were trying to say about what is happening with oil demand, and we saw these big adjustments and why these adjustments were happening. So this is just looking at the forecast on the need of OPEC crude, has been cut by the IEA, EIA, and OPEC. So you can see that there's been a big adjustment in terms of the amount of crude that is going to be required. And it's more because of the demand side and how demand has shifted when we look at the end of 2021 and then into 2022. And when you look at why there's been such a cut into next year, you have to look at what is the growth expectations for non-OPEC, what is the expectations of demand, and that's where you start to see some of this cut. Now, OPEC obviously has a specific agenda, but this is just something to look at, which is why we're talking about the IEA, EIA, and OPEC. So then when we look at the demand rewrite, if you remember when the IEA took their demand up so aggressively in the back half of 21, we were like, look, that's just wrong. It's wrong in the sense of where we thought things were going to go. And it all comes down to assumptions, because at the end of the day, you're putting your finger to the wind, hoping your assumptions play out. If COVID didn't become a bigger thing again, and with the Delta variant, which is one of the reasons why you can blame COVID, but the thing that we always talk about, and we try to drive it home every week in the Econ Show, we're looking at the macroeconomic backdrop as well, and it continued to worsen. It continues to worsen in Asia. Things in Europe have gotten better, but again, but not as good as the estimates that are out there. So you have to look at some of these adjustments, and that's why we just thought when there was that big increase in the back half of 21, we thought it was just too much. And then when you look in 2022, you have to consider the offset of, all of this fiscal stimulus that has come, and this is a global statement, not just looking at the U.S. When all this fiscal stimulus pulls a lot of demand forward, then you have this lull, and that is also kicking in to some of that lower demand as we go into 2022. With Q1 2022 also carrying some of those headwinds as we look at some of the Delta variant, and if things are tough in the summer, what does it look like in Q1? And then you have the Lambda variant and whatever Greek letter you want to throw into it, which is again keeping people a bit cautious, or more, I should say, more cautious as we go into 2022, because we've always been on the more cautious side just based on what we're seeing in the data sets that we evaluate in those high frequency data points. And this is one of them. When we look at workers slowing their return to the office, I thought this was just a good chart giving you an idea of kind of where some of those adjustments are. We've seen Amex, Facebook are just two of the most recent to kick back when they're going to expect their employees back in the office. And you can see how that's really kind of carrying out as we close out the summer. Now, on the positive side, we have seen a big increase in gasoline demand for this week so far. As my birthday was yesterday, I can attest to the fact that a lot of people take vacation this time of year. When I was younger and I'd look to have a birthday party, it was always at the end of August because everybody was away this week. And then when you look at the statistics, this is actually one of the busiest weeks for vacations. So it's not surprising to see this increase, but again, this is something that we want to see some of this trend continue, because we continue to see this an increase, then a decrease. So we want to see what kind of consistency we can get. Now, I have a article coming out in Politics Today looking at water scarcity, food, and I focus on that article within Iran. And I thought this was a good article that I had found. And this is back from 2019, looking at water scarcity. And when you look at this, you can see the Middle East is obviously really high, but look at Iran. Iran is number 5. You have Qatar at number 1, Israel number 2, Libya. So you get an idea of just how scarce water is, and just when we fast forward to 2021, and things have only gotten worse. Especially, you look at India at number 13, Pakistan at 14. when you're losing water, you're not only losing the ability for yield for crops, you're also risking illness, because then you have water problems in terms of what is available for human consumption. But these are some of those bigger issues that continue to stress the system as these weather patterns shift, and we're just seeing this yield cut, which we're going to go into more depth right now. So when we look at WASDE, you can see that WASDE was pretty bullish across the board. Corn end stocks came in below estimates. Production came in below estimates. Same with yield. Beans were a little bit closer to the estimate levels, but just because corn and wheat were the ones that I had the most confidence on when we look at some of the movements. But when you look at beans in general, like the production was down sizably, and when you look at where things are going forward, this is where we continue to see a lot of this bullishness. And by bullishness, I mean on price, because this is going to be a negative for the amount of crop available. And then when we look at wheat, you can see that wheat continues to miss the mark by a wide margin. And right now, just based on commentaries we're seeing, we are starting to see some new flash sales, which means that exports will pick back up. And this will pull down some of these end stocks and, again, put more into the market. But production coming down, yield coming down, increasing prices in general, and helping with that little bit of a food inflation. And when we look at what this means for the rest of the world, we have to look at the percentage of population suffering from food insecurity. So what do we have? We look at PPI, CPI, we see prices going up. We know that labor is under pressure, wages have been compressed, and food prices are going up. So you have wages coming down, you have food prices going up, which is exasperating an issue that has really been increasing when we go back to 2015. Things got a little bit better as we got into a decent bumper crop when we look at 17, 18, and then 19 was where we started to see that pivot. And that helped some of this when we look at Latin America, Africa, but now we're starting to push back up. And as we talk about in the Iranian article, and then there's another article that we're going to put together, this is where, when you look at water, when you look at food, that's when you start to see big political instability. When you start to see a lot of these people are willing to fight over food and water. I mean, that just comes down to it. And that's why we want to look at where the world is and how the world sits right now. And looking at percentage of population suffering hunger, you get an idea of just how aggressive it has gotten and how Africa is a big piece to it. Because remember, back to when we were talking in segment 1 of the Econ show, we focused on Africa because that's where we're going to continue to see some of these flashpoints, especially as this continues to become a bigger problem. But it's not just Africa. When we look at corn needed within Brazil, you can see Brazilian imports reached a 21-year high through July as domestic production suffers. When we look at Paraguay, Argentina, all other, you can see that Brazilian imports, again, all of these problems continue to struggle, and that's why they're importing the most, because they just don't have enough. And remember, a lot of these places are net exporters, and this is just going to take additional capacity out of the market, pushing those prices higher. So then when we just put into perspective where the U.S. is, so the outlook for the new U.S. New crop of corn carry out at 1.242 billion bushels is the smallest for this point in the cycle in 9 years. And you can see based on the red line just how bad it really is. Old crop carryout at 1.117 billion bushels is an 8-year low, but USDA this month increased that number for the first time in a year after demand trimmed. So the demand side is built because we saw a pretty big slowdown in exports. And from what we're seeing, that's starting to reverse. So that will adjust it a bit, but just gives you an idea of kind of where we sit. Then when we look at U.S. soybean ending stocks, new crop carryout for soybeans has been unchanged from 155 million bushels for 3 months, but 160 million bushels on old crop is the heaviest estimate since December. New crop stocks use seen at 3.54% versus 3.51% in July, and old crop is at 3.54%. This just shows you just in terms of ending stocks in general. So even though, as I was saying when we were going through some of the WASDE numbers, we said it was kind of in line with estimates, but even being in line with estimates, you're still at such a low base. So this is why it was, we weren't comfortable taking soybeans into the WASDE because, there's always a lot of volatility, but this gives you an idea of just where we sit on the soybean side. Now, shifting a bit to the U.S. and some of the inflationary prints. So when we look at the producer price index and we look at PPI, you can see that month over month, it blew through estimates, came in at a 1%. We'll talk about this more in the econ show. When we look at it, less food and energy, up 1%. When we look at less food, energy, and trade services, up 0.9. You get an idea of how we're getting this continuous increase, and this is cost. So we're looking at what is at the cost side, and this will flow down, because when you look at what has cost become, when you look at companies, they come up with their price based on their cost. And this is just looking at where things are, which is why when in the most recent econ show, we've talked very aggressively about small businesses. What is their optimism? How are things being impacted? So then when we look at year over year, because remember, month over month, I like to take away base effect. When we look at year over year, you get an idea of final demand up 7.8, less food and energy up 6.2, and then include services 6.1. So then when we turn a bit further, so when we look at import prices, and again, this is always going to ebb and flow, you can see that they came in under estimates. So U.S. import price index was at 0.3, still an increase, but below what the expectations were. U.S. import price index came in at 0.1, again below, still an increase, but you saw this gradual movement, which is something that we think is going to pick back up. Not back to the highs that we saw of that 1, but something closer to about 0.3 to 0.5 as we progress through August and into next month. And then when we look at year over year, you can see 10.2%, 1.3%, and then when we end use all commodities, and it's 17.2. So when we look at the 10.2% on the import side, and then we go to exports, so exports actually beat estimates, which means that when you look at what the U.S. has done, it's been able to push through more price increases to the local consumer because we had a lot of government transfers, some of that excess savings, but we're also able to push it through on the export side, which it's also good because it helps to protect a little bit on how much has to be recovered internally, being able to outsource some of that into the exporting market. And then when we turn to the import market, we continue to import those price increases, which continue to go up. So we had another shutdown of a port in China, which is a very big port especially for the U.S., which has sent container prices back to the highs and sending prices ever higher when we look at what is happening in the U.S. and what is happening abroad. And so there was a great question that was posed to me of, is this something that China is doing to manage their own internal inflation, forcing these shutdowns of ports because it was one person that had COVID and that person was a vaccinated individual. And I think it's a mixture of things, and that is it's a good assumption. But one of my response was that there is still a zero tolerance within China, which is being fiercely debated right now because of things like this, where they're saying, look, we know Delta isn't as bad. We know that there isn't the same type of fear. So maybe we can just cut back and still have things operational. But as of right now, there is a zero tolerance. And that is a political blunder, in my opinion. But again, a political issue. But there's also the other side of, well, how many containers do they have? Do they have enough containers? Is this a way to try to hide the fact that they're not going to operate normally? Or what I think is also a good scapegoat, and I wrote about this in our Insights to Clients today. When you look at the economic growth of China, it is well below, just putting everything together, their target. So if you want to come up with an excuse, what better way than, oh, well, it wasn't us, it was COVID, we had to shut down this port in these provinces, and it gives them an easy out to miss that target. And I think that's going to have to be something to watch. And that is, I think, one of those benefits where maybe it isn't a political blunder, but political strategy to avoid looking like they missed that number as big as they did. So again, those are going to be things to weigh as we go forward. But it's not just China seeing it. It's not just the U.S. seeing it. It's not just India. It's also South Korea. And remember, back to segment 1 of the Econ Show, we talked about how a lot of prices keep going up. A lot of that keeps going through. And again, China is a big exporter to a lot of the world. Obviously, U.S. is number 1, but South Korea is up there in the top, and I think it's the top 7. So as their prices go up, as we looked at their PPIs, well, then their prices are going to go up because South Korea is also seeing price increases. So again, these are just more aggressive moves. And for those that talk about technology always being deflationary, well, look at from 2017 as we went into 2018 and then into 2019 and then through 2020. This is where we come to a point where things reach that terminal velocity and start to turn back up. And I just think this was an interesting chart looking at that. But again, we'll talk about that more next week. And then when we look at the money supply within China, you can see that it actually shrunk and it came down more than estimates, especially when we look at M1 and M2. And if you remember last week when we talked about how there was that little bump, last month, where we talked about there was that little bump in M2, and we're like, look, that is something that was more structural, but we think that they're going to overreact now to the downside, and take out more than they put in. And that was exactly what happened as they look to manage their credit impulses, and they continue to manage liquidity very aggressively. Now, if you've made it this far, then you'll know how much I love to talk about the reverse repo purchase in the U.S. And you can see how we keep getting over $1 trillion into the RRP. So we did it. We've officially broken the system with over $1 trillion of excess liquidity that banks can't put into the market. So they'd rather park it at the Fed. So just a nice little cap on just where we sit in today's world on the liquidity side. So I know we went through a lot. Some of these will be bigger points as we go into next week in the EIA show, in the economy show. Please go back, watch the econ show. It has a lot of these data points in more depth. So we appreciate you watching. Please like, share, subscribe. Your support is appreciated, and we hope you have a great weekend. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primer Vision Network.